Welcome back to the Deep Dive. Today we're doing something a little different. Usually we take a pretty broad look at a topic. But today we're zooming in with a microscope.
We are.
We are staring down the barrel of what many of you have told us is the absolute final boss of the equity compensation exam.
We are talking about Chapter 8, modifications.
Modifications. It sounds so harmless, right? Like you're just tweaking a spreadsheet or fixing a typo.
Yeah.
But if you're in the trenches of ASC 718, or if you're sweating over this exam prep, you know that modification is basically code for accounting nightmare.
It can be. It is consistently one of the areas where people lose the most points on the exam. And, in the real world, it's the place where good intentions like trying to help an employee out can accidentally blow up your company's P&L.
Exactly. So here's the mission for this deep dive. We are unpacking the 20th edition of Accounting for Equity Compensation, specifically focusing on sections 8.1 through 8.4. We aren't just skimming. We're going to break down the accounting for repricings, accelerating vesting, and extending exercise periods.
And the goal is that by the end of this, you won't just memorize the rules, you'll actually understand the mechanics so well that you can look at a scenario and instantly know if it's, say, a type I or a type 3 modification.
Okay, so before we get into the specifics, the repricing, the terminations, we have to start with what you call the golden rule. I feel like people gloss over this. In the real world, we just sign an amendment. But in the accounting world, what's actually happening?
This is the hurdle. You have to clear this first. You have to stop thinking like a lawyer and start thinking like an accountant. In the eyes of ASC 718, you cannot simply edit an award.
Okay.
A modification is treated as an exchange. You are effectively canceling the original award, tearing it up, shredding it, and at the same time, granting a brand new award.
Cancellation and a new grant.
Precisely. Even if the only thing you change is the strike price or the expiration date. The accounting model processes it as the old deal is dead, a new deal has been signed.
And that framework, that idea of cancellation and a new grant, is what drives all the math we're about to get into.
It drives everything. Once you accept that you're dealing with a new grant, the question just becomes, how do we measure the value of the new thing versus the value of the old thing?
Okay, let's apply this. The first major headache in Chapter 8, Section 8.1, reducing the price of a stock option, the classic repricing.
A classic scenario, the market tanks. Your stock was at $50, now it's at $20. You have critical employees holding options with a strike price of $50.
So they're underwater. Deeply underwater.
Yeah.
They're essentially worthless. HR is panicking because these high performers are looking at their comp package and seeing zero. So the company decides, let's just lower their strike price to $20 to make them whole.
Right. And this brings us to our first conflict between, intuition and accounting. If you're studying, you're probably thinking, okay, the old $50 options were worthless, we canceled them. So surely we can reverse the expense we already booked for those old options, right?
That would be my logical assumption. If I return a defective product, I get my money back.
But in equity comp, the answer is a hard no. You do not reverse the expense for the original underwater options.
Why not? That feels incredibly punitive.
Right.
The employee never got any value from them.
It does feel punitive, but think about the service period. The company granted those options in exchange for labor. Did the employee show up to work?
Yes.
Did the company receive the service? Yes. The fact that the currency, the stock option lost value is unfortunate, but the company still spent that equity to pay for the time worked. That expense is a sunk cost.
Okay, so I'm stuck with the bill for the old dead options. But now I've issued these new $20 options.
Yeah.
I assume I have to pay for those too.
You do. This is what's called a type I modification, or probable to probable.
Meaning it was probable they would vest before, and it's still probable they'll vest now.
Exactly. The vesting probability hasn't changed, only the value has. So what you have to do is calculate incremental expense.
Okay, walk us through the math on that. I know the exam loves this calculation.
It's a comparison snapshot taken at the exact moment of modification. You calculate the fair value of the new award immediately after the change. Then you subtract the fair value of the old award immediately before the change.
Hold on. If the old award is underwater strike price 50, stock price 20, isn't its fair value 0?
No, and that is the trap. Its intrinsic value is 0, yes, but its fair value using a model like Black-Scholes is almost never 0.
Because of time value.
Exactly. Even a terrible option has time value. If it has years left before it expires, it's like a lottery ticket. It might be worth 10 cents or 50 cents. So you take the new value, maybe $5, minus the old value, maybe 10 cents. That difference, $4.90, is your incremental expense.
And that gets stacked right on top of the old expense.
Correct. You continue recognizing the old expense schedule, and you add this new wedge of expense on top of it.
That sounds incredibly expensive. You're paying for the dead options and the live ones.
It is expensive. That is why standard repricing is often considered, well, a failure of plan design or just a desperate measure. It looks terrible on the P&L.
Is there a way to fix the underwater options without taking that massive hit? Section 8.1.2 talks about something called a value for value exchange.
This is the elegant solution. If you want to avoid incremental expense, you have to balance the equation. You go to the employee and say, look, we will lower your strike price to 20 so your options are in the money. But in exchange, you can't keep the same number of shares.
So you're trading quantity for quality.
Precisely. You run the math to make sure the total fair value of the new grant with fewer shares, higher value, exactly equals the total fair value of the old grant, more shares, lower value. If those two numbers match, what's the difference? Zero. And if the incremental value is zero, the incremental expense is zero. You just keep booking the original expense like nothing ever happened.
That seems like the obvious choice for a CFO. But I imagine employees hate hearing, we're cutting your share count.
It's a hard sell for HR for sure, but mathematically, it's the cleanest path.
Okay, one more variation here in section 8.1.3 I want to touch on. Exchanging stock options for full value awards, like RSUs.
Yes, this is very common. The company realizes options are just too volatile for their workforce. They say, hand in your underwater options and we'll give you restricted stock units instead.
And does the math change because it's an RSU?
The concept is identical. It's still a modification. You still compare the fair value of the new RSUs to the fair value of the old options. Since RSUs are worth the full stock price, they're much more valuable per share than an option.
So you'd have to cut the share count drastically to avoid that P&L hit.
Drastically. You usually see ratios like 3-to-1 or even 4-to-1. But the accounting rule is the same. Calculate incremental cost based on the difference in fair value.
Okay, let's pivot. We've covered fixing the price. Now let's talk about fixing the timing. This is our goodbye scenario.
Acceleration of vesting, section 8.2.
Here's the setup. An employee is being terminated, maybe a layoff, maybe retirement. They're 75% vested. The board, feeling generous, says, we'll accelerate that final 25% so you leave with 100%.
And this is a type 3 modification. This is where the logic completely flips upside down compared to repricing.
Type 3, improbable to probable. Let's unpack that.
So think about the status of that final 25% before the board stepped in. The employee was leaving. Under the original contract, what was going to happen to those unvested shares?
They were going to be forfeited.
Gone, right? So the probability of them vesting was zero. It was improbable. By accelerating the vesting, the board has now made the vesting probable. They've taken something that was effectively dead and brought it back to life.
Dead to alive. I like that. So how do we account for resurrection?
First, you look at the old award, that unvested chunk that was going to be forfeited. Since the service condition was not met under the original terms, you get to reverse the expense.
Wait, we actually get to reverse it this time?
Yeah.
Unlike with the repricing.
Yes. Because in the repricing, the employee stayed. The service was met. Here, the employee is leaving. Under the old deal, they failed the test. So you wipe that accrued expense off the books.
That sounds great for the P&L.
Well, don't celebrate yet. You wipe the old expense, but you have just granted a new, fully vested award. So you have to recognize the full fair value of that modified award immediately.
So I save the old expense, but I take a massive hit for the new value all at once.
Exactly. And usually the new value is higher than what you reversed, so it's a net expense. But the mechanic is crucial for the exam. Reverse the old, book the new. That's the hallmark of a type 3.
Now this brings up a massive gotcha from Chapter 8. Discretion. What if the contract always said, if you retire, you automatically vest?
That is the single most important distinction in this whole section. If the acceleration is written into the original grant, vesting accelerates upon death, disability, or retirement, then it is not a modification.
It's not.
No. The terms haven't changed. The plan is just executing the code that was written at the very beginning.
Yeah.
In that case, you don't do any of this cancellation and new grant accounting. You just speed up the expense recognition because the service period effectively shortened to today.
So modification accounting only triggers when the board changes the rules mid-game, using discretion.
Precisely. When they use discretion, if the board has to meet, vote, and sign a paper to make the vesting happen, you're in Chapter 8 modification territory. If it's automatic, you're just in standard expense attribution.
There's a really nuanced case in Section 8.2.5, accelerating service but not performance. This feels like a classic exam curveball.
It is, and it confuses everyone. Imagine an award that says you must stay for 3 years and the company must hit $10 million in revenue.
A dual condition, service and performance.
Right. The employee quits after 2 years. The board says, we like you, we will waive the service requirement, you don't have to stay for the 3rd year, but you only get the shares if the company actually hits that $10 million target.
So they're off the hook for working, but still on the hook for the revenue goal.
Exactly. So is this type I or type 3?
Well, they were quitting, so they were going to forfeit. That was improbable. Wow. It's possible.
It's type 3. It was improbable because forfeiture was certain. Now, the service condition is satisfied, so you treat it as a new grant. You reverse the old expense. But here's the catch. How do you book the new expense?
Well, we don't know if they'll hit the revenue target yet.
Right. So you treat it like any other performance grant. You assess, is the revenue target probable? If yes, you book the new fair value. If no, you book 0 and you wait and see.
That's wild. So the employee's gone, not providing services, but the company's P&L is carrying this zombie expense depending on sales numbers.
Yes. It creates an award that is totally detached from the employee's employment, but still attached to the company's performance.
Before we leave acceleration, what about Section 8.3.1? Accelerating underwater options. Why would anyone bother accelerating an option that's worthless?
Usually administrative cleanup. A company who just wants to clear the books. An employee is leaving. They have unvested options at 50. Stock is at 20. The company says, keep them, vest them, good luck.
Does that cost anything?
Technically, yes. It's a type 3 modification. You reverse the old expense. You book the new fair value. But since the option is so deeply underwater, the new fair value is tiny, just a few cents of time value. So it's a very cheap way to look generous.
Here, have this worthless piece of paper.
Exactly. But you still have to do the accounting correctly.
All right, let's move to part 3. We've done price. We've done vesting. Now, time. Section 8.4, extending the post-termination exercise period.
Or as I call it, the hidden cost of kindness.
The scenario is simple. An employee leaves. They usually have 90 days to exercise their vested options.
Yeah.
But the board says, look, let's give them 3 years to exercise instead of 90 days.
On the surface, this feels free. The options are already vested. We're not giving them more shares. We're just changing a date on a calendar. Why does that cost the company money?
I can hear a CEO arguing this. We aren't giving them anything new.
But you are. You're giving them time. And in the Black-Scholes model, time is one of the most powerful drivers of value.
Explain that relationship.
Think about the inputs to Black-Scholes. You have volatility, interest rates, and expected term. If you have an option that expires in 3 months, it has very little time value. It doesn't have time to recover if the stock dips.
But an option that expires in 3 years?
That has 3 years of volatility ahead of it, 3 years of potential growth. It is a much, much more valuable financial instrument.
So when the board changes 90 days to 3 years, the fair value of that option jumps.
Immediately.
Yeah.
And that jump, the difference between the value with a short term and the value with a long term is your incremental expense.
And since the employee has already left and is fully vested,
You can't spread that cost out. There's no future service period. You have to recognize that entire incremental cost immediately, a one-time expense.
boom, one lump sum hit to the P&L just for extending a deadline.
And there's a compliance monster lurking here too, which Section 8.4.4 highlights. We have to talk about Section 409A.
The tax boogeyman. What's the danger with these extensions?
This is critical. You generally cannot extend an option beyond its original contractual term. Most options have a 10-year max life.
Okay.
Even if you want to be nice, if you extend an in-the-money option beyond that 10-year limit, you're creating a prohibited deferral feature.
Which translates to?
Penalties. Massive tax penalties for the employee. Often a 20% excise tax plus immediate income recognition. You're trying to be nice, but you end up handing them a tax disaster.
So the rule is, you can extend the window within the 10 years, but never push the wall back past the 10 years.
Correct. Never breach the original max term.
We have covered a massive amount of ground. My brain is full, but we need to verify this all stuck.
It's time for the knowledge check.
I've prepared 3 scenarios based on Chapter 8. I'll set the scene, you walk the listener through the answer.
I'm ready.
Okay. Scenario 1. Company has underwater options. They do a standard repricing, just lowering the strike price. The CFO asks you, great, since the old options were worthless, we can reverse that expense, right?
The answer is no. This is a type I, probable to probable modification. You never reverse the expense of the original award because the service was rendered. It's a sunk cost. You continue to recognize the old expense plus the new incremental expense.
Perfect. Scenario 2. The CFO hates that answer. She wants a solution with zero P&L impact. You suggest a value-for-value exchange? What's the specific lever you have to pull to make the incremental expense zero?
The lever is reducing the share count. To make the expense neutral, the total fair value of the new award has to equal the total fair value of the old award. Since the new options are more valuable per share, you have to grant fewer of them to balance the equation.
Excellent. Last one. Scenario 3. An employee is terminated. They have unvested options. The board uses its discretion to accelerate those options. Is this a modification, and what happens to the old expense?
Yes, it is a type 3 improbable to probable modification because it relied on discretion. And regarding the old expense, you reverse it. Because the award was originally going to be forfeited, you wipe the old expense and then recognize the full fair value of the new accelerated award immediately.
If you tracked with those three, you are in excellent shape for the exam.
Those are the cornerstones. If you get the difference between type 1, the repricing, and type 3, the acceleration, you have won half the battle right there.
So let's wrap this up. If we have to summarize Chapter 8 into a single mental model for the drive home, what is it?
The mantra is cancellation and new grant. Stop thinking about editing contracts. If it's a repricing, you're adding cost to an existing deal. That's type I. If it's acceleration, you're swapping a dead deal for a live one. Type 3. And if it's an extension, you're just paying for the value of time.
Simple, logical, but unforgiving if you miss the details.
And I want to leave the listener with one final thought. We talked a lot about discretion. We saw that using discretion is exactly what triggers these accounting headaches.
It's the trigger for modification accounting.
Right. So look at your plan design.
Yeah.
Does your company rely too heavily on board discretion? I see so many plans that say the board may accelerate or the board may extend. Every time you see that word may, you should realize you're opting into volatility.
Because every time you use that may, you have to do evaluation and potentially take a charge.
Exactly. Sometimes hard-coding these rules into the plan up front, like automatic acceleration on death, saves you a world of pain on the back end. It might feel less flexible, but flexibility is expensive.
That is a great strategic takeaway to end on. Flexibility costs money.
It really does.
Well, that does it for our deep dive into Chapter 8. We hope this helps you navigate that modification minefield and crush that exam. Good luck with your studying, and we will see you on the next one.
Happy accounting.